Kenya, still very much a focus for us here on global business. It's held, of course, it's essentially a rerun of its presidential election on the 26th of October. Let's see how investors are perceiving the country, especially at this point in time. Christopher Dielmann is a senior economist at Exotix Capital. He's live in London right now. Christopher, thank you for your time. So let's talk about exchange rates, if we may. The dollar-shilling rate relatively stable, but we're not seeing that sort of stability in the sterling shilling cross or the euro shilling cross. Aside from central bank support for the shilling, is there any fundamental basis for that stability we're seeing in the dollar-shilling cross?
I think you're correct. I think if you look over the past year, you see that there's quite a bit of stability. And the shilling's been trading relatively flat to the dollar. If you look at the euro to the shilling or the pound to the shilling, you see quite a bit more volatility. Also, if you look at the triangulated cross rates, you can see that there is been quite a bit of a run of both the pound and the euro. I think perhaps a better way of thinking about this is looking at the real effective exchange rate, which is a method that tries to value one country's exchange rate or its currency against a basket of all other currencies. If we look at it from that perspective, we can see that the pound and the euro have actually appreciated over the past 12 months, and the dollar and the shilling have been quite flat. So taken from that perspective, I think that we might be seeing a tad of a spurious correlation, that there might actually not be that connection that sort of the flat rate might imply. In other words, I think there might not be the arbitrage opportunity between these currencies that some people are looking for.
Indeed. So let's talk about the macro side of it, though. Kenya's debt to GDP ratio fast approaching 55%. Debt service for the last 5 fiscal years already taking up about 20% of recurrent expenditure. With those sort of numbers, Kenya can't fund a stimulus package to at least kickstart growth through debt anyway in 2018, can it?
So I think to really talk about this issue, we'd have to spend quite a few hours talking about it. But in short, I think the answer is yes. The International Monetary Fund actually projects their debt to GDP level to fall from about 55% today to just below 50% in the medium term. So that's over about the next 5 years, with falling debt service ratios as well. That being said, I think really the question is, if Kenya can still issue debt, if there are international investors interested in purchasing these products, which it seems like there are, it seems like they'll be able to manage that debt load quite reasonably. There's two things that we really know about Kenya's debt dynamics. One is that Kenya has very strong real GDP growth, projected at 5 to 6% over the next few years. And they also have very high net FDI inflows. So really the takeaway from that is, as long as Kenya can continue to grow at the rate that it's projected to, and that it can keep attracting international capital inflows, it'll be quite easy for them to manage their debt load and actually use that as some sort of a fiscal stimulus going forward.
Right, but let's zero in on that growth number for just a bit now. Kenya's Treasury has actually cut its 2017 growth forecast rate again. In late August, it expected 5.5% growth. Now it's down to 5%. That's a second revision this year. Some economists think we'll be lucky to get to those levels. They're expecting anywhere between 4.25% and 4.75%. What do you expect full year growth to settle at, and why?
Right. In short, I would probably agree with those numbers. The IMF actually came out a few weeks ago and actually cut their growth expectations as well by about 0.25%, citing both the election and fiscal slippage as a result. I think the initial 5% expectation would be quite reasonable. That being said, that was very much programmed on the basis of having a smooth election process. Given that what we've seen so far is anything but smooth and there isn't no real end in sight, we don't really know when a new president will be elected, we don't know when the new government will be formed, and we certainly don't know when the violence will subside. Given that, it's, I think, quite optimistic to expect the 5% that some people have targeted, and it would be very easy to see that number slipping below the 5% by year end.
Right. One last question for you, Christopher. Lending to the private sector pretty much has been flat, non-existent really all year, but we've got IFRS 9 accounting rules coming into effect from January as well. What effect do you think that will have on lending to both the public and the private sector and provisioning levels among Kenyan banks?
Of course. Unfortunately, I think that's quite a difficult question to answer, mostly because there is so much uncertainty in regards to IFRS 9 and exactly what that will mean for both firms and auditors. The current expectation is now that the Central Bank of Kenya will release its implementation guidelines in December, which will give firms only about 1 month to actually figure out these new regulations before them being implemented. As a result, the one thing that we are quite certain about is that their capital reserves will probably increase as a result of not exactly knowing how any of their financial instruments will be priced going forward. The other takeaway from that is that it will be quite difficult to price risk in the short run. And if we combine that, sort of the risk pricing, the capital reserve increases, as well as the current interest rate cap, it seems like there's going to be quite a big squeeze on private sector credit, as well as lending to the government.